Devina Mehra is with us, founder and chairperson and MD at First Global. She's in our studios. Devina, good to have you with us here. Always on the line, but now today face to face. So what's your answer, Devina? What's responsible?
So first of all, let me say that, which I must have repeated sometime or the other on your shows also, that I do not think that FIIs coming or go. I mean, why do we ask the question that will FIIs come in or not? We say that if when FIIs buy, the market goes up, and FIIs sell, the market goes down. But that doesn't hold. If you look at a long enough period, there is no correlation, let alone causation. And we had these red kind of bars. But remember when FIIs first started coming in, the bars were all green. But 1994 is roughly when the FIIs started coming in. And 94 to 2003 is a 9-year period in the Indian market history where the net displacement was zero. You would have thought this is a new source of money and tons of money coming in, it will drive up the markets, but it didn't. But of course, the fact is that, and which is something I posted on, that recently Wall Street Journal did a piece on emerging markets, and either as a positive or a negative, India was not mentioned at all. So you are really, I mean, this is as good as being off the radar. I haven't checked the latest numbers, but till a few weeks ago, the top performing markets in the world were all emerging markets, and still you were bringing up the rear. So that's there. But the diagnosis, what you mentioned, that it is because India doesn't have an AI play, or if you want to use consultant speak, India does not have an innovation story. That's how people say it. But that is, again, yesterday's story. If you look at how the global markets have moved, and particularly also how US has moved, everybody thinks it's the Magnificent Seven driving the US. That was the story 2 years ago. It's changed considerably since. So if you look at the Mag 7, which is the 7 big tech companies, Microsoft, Meta, Amazon, Google, Nvidia, Tesla, they accounted for more than 50% of the S&P up move in 24, in 23. In 25, it was down to about 40%. But the more important part is that only 2 stocks drove it, Google and Nvidia. All the other 5 underperformed the S&P. This year, again, of the 7, 5 have underperformed the S&P. Only Google and Amazon have outperformed. But more important, the S&P has hugely underperformed the Russell 2000, which is the broader index. So the action has moved to old economy. So in Russell 2000, every single sector is up. So Russell 2000 in the first 4 months is up 13.5% versus 5% for S&P. And the more important thing is, even when you see that in both these, the technology appears positive, but technology is not what you are thinking as the AI play in the narrow sense of these companies which are setting up the AI facilities. Actually, now what is moving is all the stocks that are gaining from the huge capex going into AI. So it is the electronics, it is the
memory, etc.
Yeah, semiconductors.
I'll tell you, a small 20% of S&P of Russell is AI, by the way. Now 20%, and I was just looking. If you take out AI, that 20% from the Russell 2000, earnings growth, and we're in the earnings season. Earnings growth of the Russell reduces by 50%.
I haven't done that cut, but the fact is that...
my only point is...
No, but I mean, the valuation of even, let us say, of course, the energy companies are leading, but even companies like Walmart or Costco, all these have done very well. So Johnson & Johnson. So a lot of the old economy companies have done well. And as I said, the AI play is now the capex into AI play.
No, that's fine. I'm just saying that I'm just sort of bunching everything in there, basically. AI, one broad kind of thing. It's not just LLMs or the data centers, it's everything, which is...
so even old-style networking companies, Dell and SanDisk and all these have kind of come out of the woodwork and are doing very well.
What is your diagnosis, Devina? What is it?
So I'm saying first...
The FI question.
No, as I said, I don't spend time on the FII question because I have seen no correlation between the FIIs coming in and what happens to India in terms of the stock market. Where it does concern me is the balance of payment. So you're on net FDI, you're not doing well.
I'm not, the end result, you're bothered about it, but for a different reason. But what is the diagnosis?
So, I mean, see, all these things are kind of, you can build any story at any point in time. So if FIs were coming in, you could have come up with a good story. And you can come up with a good story if they're not coming in. Yeah. So it is just, as of now, you are off the radar saying that you are expensive. I mean, India was always expensive. So you should have made that case in 2024 that India is too expensive. Why make it now when it is far less expensive? And relative to its own history, most sectors in India are actually lower than where they used to be. Many sectors, the PEs are below average, and they're certainly not at extreme ends. So, I mean, this is just looking for stories to justify what's happening in the market. Just as, you know, consumption also in 2024, beginning consumption was at a 21-year low, but nobody was talking about it because the market was booming. Once the market started to go down, it became that, you know, consumption is slowing down.
Okay, let me, so, you know, AI, no AI, earnings growth matters, right? For stock markets from an investing point of view. So this is the latest Jan to March, if we can have the numbers up on the screen. I just pulled this up. This is 3 days old, so maybe numbers are a little different. MSCI India, if you can, do we have the, yeah, there you go. That's Jan to March because it's Q1 in the US. MSCI India earnings growth is 8%. S&P so far is 24%. Expectation was 12%. And the MSCI emerging market EPS growth is 38%. This is the quarter that we're in, Jan to March, for which we are still getting numbers and which is now coming to a bit of a close, right? Korea and Taiwan are driving regional and emerging market EPS growth for reasons that Devina also sort of alluded to, SanDisk and whatnot. There's TSMC and, I mean, lots of stuff here, right? But all in that broad AI basket. AI, capex super cycle, I mean, some of these reasons are well known. And this is interesting. Korea's 12-month forward PE is now 6.6 times, Devina. 6.6 times.
Actually,
the last week it was 7 times. Right. So from 7, it's come to 6.6, despite the index going up 2% because of the earnings upgrades that I'm talking about. And to the point of how much these companies, the 5 largest hyperscalers, are going to spend in capex, $751 billion in 2026. It's up 83%. They'll spend 83% more than they spend in 2025.
Yeah, I mean,
so that money is kind of...
Yeah, I mean, they used to spend $150 billion a year. Now they're talking 700 plus. Yeah. It's another story, and I think it's a when, not an if, that you will not make enough return on capital in all this.
That is another debate.
Yeah, so I mean, well, that is coming. As I said, it's a when, it's not a if. Because right now you're just spending because you have, in order to be in the game, you have to spend. But that's never a good thing. And that's also what is giving pricing powers to the Microns of the world, that you can charge anything, but they just want... power utilities are doing well. In fact, in India also, power utilities and power equipment manufacturers are looking good because of data centers. Because
you're constructive as far as the market is concerned here in India right now.
In India? I think 2026 will be, in probability terms, better than 2025, simply because for the first time I hear everybody talking risk. Otherwise, everybody was selling the quote-unquote India growth story. So, you know, now that you're talking risk, sentiment is a contraindicator. I mean, this is not my opinion. This is research studies around the world.
Talking about sentiment, Devina, here's Samir Arora. If you can quickly pull up that soundbite. He said, well, he's been marketing for 30 years. He was in the US. He's never heard people so upset. So, again... indicator that sentiment. Let's just play out a quick piece of that soundbite.
I'm on the way back from US, and the people that are upset, my God, I've never seen people so upset with India. And I've been marketing for 30 years. I started marketing in 93 for our first offshore fund and must have gone to 30, 40 countries. This is just too much on taxes. I didn't realize even on debt taxes, people are upset. I met some debt guys who said that they have been saying forever that the debt taxes also India stands out in the sense that we, I believe, tax, I don't know all these because I don't do debt, that even on, like if you buy a bond and there is some interest accrued before that, no other country charges tax on that to the new buyer. So they say that also we have to pay. And then they were a little bit upset with FX. There are many, many things they are upset with. And in general, I would say, you know, these things on whether we have AI or not. Actually, I recently saw on social media that Ruchir Sharma said that India does not have AI, and that is the reason FIIs are not investing. So that question came up everywhere, and I used to say that there are 198 countries we do not have their own LLM models. So you treat us like those 198 at first level, not just compare us to US directly. And then I found that in India, people are saying, no, that is not the reason. Ruchir Sharma is wrong. So then what is the reason? Because there is something definitely different. And according to me, that difference is not LLM and it is not this thing. It is taxes which are obscenely different. And because of currency weakness, they are upsetting people even more because the taxes have been charged on rupee profits. The other problem, which I also had, but I never realized that everybody has, is that if you are running an open-end fund and you pay taxes every quarter, and then if in the end you make losses and then you have to get your taxes back, for another 15, 18, 12 months, you won't get your money back. And how does that work in an open end?
Okay, well, that is Samir. So another contraindicator. Samir himself acknowledged that he's bullish, by the way. He's saying, I'm not negative, but people are upset and he blames taxes. And it's been a pet peeve with him for a while.
Yes, he's tweeted often enough on taxes. But then saying the research studies show that sentiment is a contraindicator. So when sentiment is overbuoyant, the next period returns are below normal, just as you saw, through 2024, and then that whole Samvat was a zero. And on the other hand, when sentiment is down in the dumps, when your people are asking that should I get out of the market, is when the next period returns are above normal. That is wherever the study has been done, Portugal, Brazil, US, India, everywhere, it's the same pattern. So the times you have to be cautious is when your brain is telling you it's so easy to make money.
Yeah. And often it's not. It's kind of it's very hard to do. Devina, lovely speaking with you. Thank you very much. Appreciate you joining in. We have earnings. So Mahindra earnings came through and we have the management waiting. Thank you very much.
Thank you.